So Brian, thanks for joining Westpac Wire for the interim results.
Michael, good to see you.
So Brian, the cash profit number looks like it's coming slightly ahead of expectations on some good margin and cost outcomes. But the growth outlook, I guess, looks a bit challenging, and there's obviously some trust and reputational issues associated with the Royal Commission. Is that a fair summation of the result?
I think it's a good summary. It's a good result. It's a high-quality result. The result is clean. We don't have any one-offs in the result. And what it represents is the consistent delivery of our strategy over the last couple of years. I think we've got a very clear idea of what we're trying to do and how we're trying to change the company for the better. We have continued to be disciplined in the way we manage our balance sheet, in the way we manage margin and returns. We're making good progress on efficiency. So I think our people have every right to feel quite good about this result. But it is a difficult external environment, and that's weighing on the sector as we've seen. But I think the important thing to remember is that the Australian economy is fundamentally sound. It's still growing. The credit quality of our book is good. And so while there may be some tightening up of things around the margin, we're still talking about positive growth for the sector, or certainly from a Westpac point of view.
And just on that top-line growth outlook, obviously it's a bit topical at the moment. What are you telling investors? Where's it going to come from?
Well, we have had a period of some tailwinds, and we will have some headwinds in the next little while. We've seen funding markets have tightened up a bit, and we've seen an increase in some of the funding costs. That'll weigh on us a bit. There are clearly costs associated with the increased regulatory scrutiny, the Royal Commission, and the like, which we're having to absorb. But we still have opportunities to grow our business, and that's what we'll be trying to do.
And on the Royal Commission, there's obviously been some disturbing findings and evidence. But more broadly for the economy, there's some debate about the impact it might have on the flow of credit if banks have to tighten up a bit more. How much of a risk do you see that?
Well, I think it's important to remember that a lot of the tightening that people refer to has been happening over the last couple of years. And we started making changes back in 2015 to the way we did our credit policies and our approval processes. And that's continued over the last couple of years. We've done a few more things this past year. But we're still seeing growth. Credit growth has still been in the 5 to 6% range for home lending. Now, with the changes that have come through in the last year, we may see that growth rate fall a bit, and I think that's probably a likely outcome. But what that represents is an orderly slowdown in the housing market, which shouldn't be confused with a reduction in the housing market. We still think credit quality is good. We think the underlying demand for housing is still there. We're seeing increased business investment. And so while we might see the growth rate come down, we're still talking about positive territory.
And that's a good segue into the mortgage book, because there's been a little bit of talk about the health of it. What are the numbers in the result today tell you about that?
Well, if you look at the actual credit performance of the book, it's very strong. We're talking about as good as it gets when you think about credit provisions overall. We don't have any particular sectors in our business that are giving us undue concern at the moment. That said, when you're managing a large credit book like ours, you can't afford to be complacent. You have to keep looking at your concentrations. You have to keep looking at different aspects of the portfolio that might be more exposed in the event of a downturn. And I'd stress that we're not expecting a downturn. And so we'll continue to work on that. But I think the evidence is pretty clear that the book is performing well. It's reasonably well seasoned, and while we can't be complacent, we're comfortable with how we sit.
And just turning to wealth management, which has obviously been a focus of the Royal Commission of late, we've seen some other banks sort of wind down or exit parts of that or announce plans to, but Westpac has obviously remained committed. I mean, can you talk us through the performance of BT of late and the role you see it playing going forward?
Well, BT actually delivered a good performance this year, and I think it's important to remember that one of the things that is a contrast between our position in wealth and some of the others is we have a strong and well-performing wealth business. Some of these other businesses have had real challenges over many years, and I think the contrast is important. There are lots of questions that's been raised, and I certainly agree that the customer stories that we've heard are terrible, and they're very sad, and they should have been fixed faster. They shouldn't have happened in the first place. But thinking about this purely through the lens of ownership of the business doesn't change the fundamental challenge, which is that customers need advice, customers need insurance, they need to get unconflicted advice, and that needs to be delivered in a cost-effective way. And if you just think about exiting the business, you're not exiting the problem for the community, which is how do you get good cost-effective advice. We've made lots of changes in the way we provide advice, the way we incent our people, the controls that we put around the way advice is delivered. We've sold down our BTIM business, so we don't have a stake in an asset manager, which I think creates some of the conflicts that people are worried about. And so we'll continue to work through these issues, but ultimately our ambition is to make sure that we are able to help customers through their financial lives, and we think that's a reasonable thing for a bank like Westpac to be doing.
And longer term, the industry at the moment is very focused on sort of shaping for the future, and that's leading to the obvious questions around what that means for costs and investments. What stage of that cycle do you see Westpac being at?
Well, this change in the way banking is done is something that we kicked off probably 3 or 4 years ago with what we call our Service Revolution strategy. That's a lot about the use of technology to streamline the experience for customers and reduce the costs internally. But to do it properly, you've got to think about the overall technology platform, and you've got to think about how you interact with customers. I would say we're about halfway through that journey over the last few years. We've made some great progress on our underlying infrastructure. Our systems are a lot more reliable than they used to be. We've introduced a whole bunch of new features and capabilities in terms of mobile banking for our customers. We've rolled out some new technology that makes things easier for our staff. But there's a lot more to go, and we've got some very exciting things coming in the next year or so that will really help ramp up the efficiency across our whole platform.
And just lastly, there's recently been a lot of attention on culture, accountability, remuneration structures, particularly in the wake of the APRA report into CBA. I imagine you're having a close read of that report and seeing if any learnings you can sort of take out of it.
Yeah, it's been a really important wake-up call for the whole industry. Clearly, each company is different and has their own issues, but there are absolutely some general themes there that I think make it required reading for anybody in the industry. It's really important to recognize that banking is a risky business, not just credit risk and market risk, but operating risk and the way that you treat customers, and all those things are incredibly important. And management of banks needs to take that stuff very seriously. We need to continue to challenge and question ourselves, and we need to hold ourselves to account when things go wrong. And we're certainly very focused on learning the lessons for that and making sure that we don't let any of the issues that have been identified in that situation creep into Westpac.
Brian, thanks for joining us.
Michael, great to see you.